Never keep more than this in your bank account. IRS is watching. Seniors in 2026. Your bank is not keeping your secrets. Every transaction you make, every deposit, every withdrawal, every transfer above a certain amount goes into a federal database. Not someday, not if you get flagged. Right now, today. The system is already running. It has been running for over 50 years, and the overwhelming majority of Americans, including millions of retirees who have done nothing wrong their entire lives, have no idea how it works. I am going to tell you exactly how it works today. I am going to tell you the specific number that triggers a federal report on your account. I am going to tell you about the second, far more dangerous type of report that has no threshold at all. And I am going to tell you the single most expensive mistake retirees make when they find out about these rules for the first time, because that mistake does not just cost them money. It turns their own legal, clean, hard-earned savings into a federal criminal investigation. My name is Mark Reynolds. I have spent 14 years as a tax strategist working with retirees on exactly the kind of financial situations I am going to walk you through today. And I want to tell you something before we get into the mechanics. The people I have seen get hurt by this system were not criminals. They were not trying to hide anything. They were people who heard about the $10,000 rule from a neighbor, or read something online, or figured they were being smart by keeping their deposits small. That thinking destroyed them financially, and it was 100% preventable. Let us start with the law. The Bank Secrecy Act of 1970 requires every financial institution in the United States to file a federal report called a Currency Transaction Report, a CTR, every single time a customer conducts a cash transaction exceeding $10,000. Every bank, every credit union, every savings institution. It does not matter whether you have banked there for 40 years. It does not matter whether the teller knows your name. The moment that transaction crosses $10,000 in cash, the report is filed automatically within 15 days, electronically, directly to the Financial Crimes Enforcement Network inside the United States Treasury Department. You do not fill out anything. You do not sign anything. You will not receive a copy. You probably will not even know it happened. The bank files it quietly, the report goes into a federal database, and your name is attached to it permanently. Now I need you to hear the next part very carefully, because this is where most people take their first wrong step. A CTR is not a problem. I want to say that again because it is critically important. A currency transaction report filed on your account creates zero legal jeopardy for you. It is routine paperwork. The federal government receives millions of these every year, and the vast majority result in absolutely nothing. No call, no letter, no audit, no visit. The report sits in a database, and that is where it stays. The report is not the danger. The danger is what people do when they find out about the report. Because here is what happens in almost every case. A person learns that deposits over $10,000 trigger a federal report. Their immediate instinct is to avoid that. They think, I will just keep my deposits under $10,000. I will break it into smaller amounts. I will spread it across a few days, maybe a few different banks. I will be careful. That decision, that specific instinct, that attempt to stay under the radar, has a name in federal law. It is called structuring, and it is defined under Title 31 of the United States Code, Section 5324, as a federal felony. Not a fine, not a warning, a federal felony. The law states that no person shall, for the purpose of evading the reporting requirements, cause or attempt to cause a financial institution to fail to file a required report by breaking up a transaction into smaller transactions. Here is the part that stops people cold every single time I explain it. You do not need to be doing anything illegal with the money. There is no minimum amount of guilt required. The money can be 100% clean, legally earned, legally inherited, legally gifted, money you already paid taxes on decades ago. None of that matters. If the government can prove that you intentionally structured your transactions to stay under the $10,000 threshold, you have committed a federal offense. The penalties are severe. For structuring violations involving amounts under $100,000 over 12 months, up to 5 years in federal prison, and fines reaching $250,000. For amounts over $100,000 or violations connected to other offenses, up to 10 years in federal prison. And in both cases, the government can seize your money through civil asset forfeiture before you are ever charged with a crime. Civil asset forfeiture does not require a criminal conviction. The government can take your money based on a civil legal standard, and then the burden falls on you to get it back. Let me tell you about what happened to a dairy farmer in Iowa. He had been banking at the same local branch his entire adult life. His farm generated cash income from roadside sales, farmers markets, and local buyers. He had always been told, by someone he trusted, to keep his deposits under 10,000 to avoid the hassle of the bank report. He had done this for years. Hundreds of deposits, all just under the threshold. His business was entirely legitimate. His money was entirely clean. He had paid taxes on every dollar. When federal investigators reviewed his banking records, they saw the pattern immediately. Regular deposits, always just under $10,000, always structured to avoid the reporting requirement. They seized $293,000 from his business account under civil forfeiture. He was never charged with a crime related to his actual business. The only issue was the banking pattern. It took years of litigation and significant legal fees to recover his money, and he did not recover all of it. These are not isolated stories. The Institute for Justice has documented hundreds of similar cases across the country. Retirees, small business owners, families, people whose only mistake was following bad advice about how to handle their own money. Now, I want to tell you about something that most people have never heard of, and that is significantly more dangerous than the CTR. It is called a Suspicious Activity Report, ASAR. Here is the critical difference between a CTR and an SAR. A CTR is automatic. Any cash transaction over $10,000 generates one. No judgment involved, no suspicion required. It is pure paperwork. ASAR is different. A bank can file a suspicious activity report on any transaction involving as little as $5,000 if the bank suspects the transaction may be designed to evade reporting requirements. There is no dollar threshold for an SAR. There is no automatic trigger. The bank files it when human judgment, or increasingly, automated software, identifies behavior that looks like an attempt to avoid detection. And here's what makes the SAR especially dangerous. You will not be told if one is filed on you. There is no notification. There is no letter. The SAR goes directly to FinCEN and can be used to initiate a federal investigation into your finances without your knowledge. You could be the subject of an SAR right now and have absolutely no way of knowing it. The behavior that triggers a SAR is not just structuring. It is any pattern that looks unusual relative to your normal banking history. A retiree who has been depositing $2,000 a week for years suddenly starts making deposits of $9,000. The algorithm flags it. Not because any single deposit crossed a threshold, because the pattern changed in a way that looks like someone who just learned about the $10,000 rule and is trying to stay under it. This is the upgraded surveillance environment that retirees are operating in right now. The headline threshold is still $10,000, but the actual monitoring happens at levels well below that, driven by machine learning systems that banks deployed starting in 2024, specifically to catch the kind of behavior the $10,000 rule has historically missed. So what does this mean practically? What should you actually do with your money? The answer is straightforward, but I want to be precise because the details matter. The first rule is to deposit your money all at once. If you receive a large amount of cash from a legitimate source, whether that is a car sale, an insurance settlement, a gift from your children, or proceeds from any legal transaction, deposit the full amount in a single transaction. Do not split it. Do not spread it across days or branches. One transaction, full amount. The second rule is to keep documentation. For every large cash transaction, put 4 things in a file. A one-sentence note describing where the money came from. Any supporting document, a bill of sale, a gift letter, a settlement statement, the bank statement showing the deposit, and any transfer confirmation if money moved between accounts. This file is your entire defense if anyone ever questions a transaction years down the road. Most people will never need it. The people who do need it and do not have it are in serious trouble. The third rule is to know the correct way to respond if a bank teller asks about a large deposit. Answer in one sentence, honestly and briefly. I sold my car. It is a gift from my daughter. I am consolidating accounts. That is it. Do not volunteer additional information. Do not explain your entire financial history. Do not apologize for the amount. And never, under any circumstances, say anything that sounds like you are trying to avoid a report. The fourth rule is to know what to say if you ever receive any communication from a federal agency about your banking activity. 5 words. I would like a lawyer. That is it. Do not explain yourself. Do not try to clear things up. Do not answer questions thinking that transparency will help. It will not help. Those 5 words will. Now I want to address something that I hear constantly from retirees and that I want to put to rest definitively. The question is whether simply having a large balance in your bank account triggers surveillance or federal attention? The answer is no. The federal monitoring system is built around transactions, the movement of money, not balances, the amount sitting still. A retiree with $400,000 in a savings account is not being flagged for anything. That money is sitting quietly and the system does not care. What the system watches is cash moving in and out. Keep that distinction clear in your mind. However, having a large balance in a bank account creates a completely different kind of risk that has nothing to do with federal surveillance. It creates insurance risk. The FDIC insures deposits up to $250,000 per depositor, per ownership category, per insured institution. Anything above that number is uninsured. If the bank fails, money above the FDIC limit is not guaranteed. Most people think bank failures do not happen. In the years since 2008, that assumption has been tested. Silicon Valley Bank, Signature Bank, First Republic Bank. 3 of the 4 largest bank failures in American history happened in a single 12-month period in 2023. Depositors who had money above the FDIC limit at Silicon Valley Bank were in genuine uncertainty about their funds for days before the federal government stepped in. The safe approach is to know your FDIC coverage at each institution and keep your deposits within the insured limits. For most retirees, that means not keeping more than $250,000 in any single ownership category at any single bank. If you have more than that, spread it across institutions or across ownership categories, which include individual accounts, joint accounts, and retirement accounts, each of which gets its own coverage limit. And while we are talking about where your money should and should not be, I want to say something directly that most people in my field dance around. A standard checking or savings account at a major bank is one of the worst places to store money you will not need in the next few weeks. The national average interest rate on a standard checking account is a fraction of 1%. Meanwhile, Treasury bills backed by the full faith of the United States government are paying over 3.5%. High-yield savings accounts at federally insured institutions are paying 4% or more. The gap between what your bank pays you on your deposits and what it earns by lending that money out is not an accident or an oversight. It is the business model. You are the product. A retiree with $200,000 sitting in a standard savings account earning 0.07% is generating $140 per year on that money. The same $200,000 in a high-yield savings account earning 4% generates $8,000 per year on the same money, with the same federal insurance. The difference is $8,000 per year that most retirees are simply not collecting because they never moved the money. Let me give you the simple framework you can act on today. Keep 1 to 2 months of living expenses in a checking account for day-to-day use. Keep 3 to 6 months of expenses in a high-yield savings account as your emergency reserve. Put money you will not need for 6 to 12 months into Treasury bills at treasurydirect.gov. Put money you will not need for 1 to 5 years into CDs or Treasury notes laddered across different maturity dates. And if you have any amount sitting above the FDIC limit at a single institution, move it today. Not next month, today. The bank that holds your deposits earns money on them every single day. The question is whether you are going to claim your share of that return or whether you are going to keep handing it to them for free. Before I close, let me give you the one rule that covers everything in this video. Because if you remember nothing else, this is the principle that keeps you safe. Deposit your money all at once. Keep clean records. Never break up a transaction to stay under a threshold. And if anyone ever contacts you about your banking activity, say 5 words before you say anything else. I would like a lawyer. Your money is yours. The law provides you with clear rights and clear protections. But those protections only work if you understand the rules that govern them. Send this video to one person in your life who handles significant amounts of cash, who recently received a large sum from a home sale or an inheritance or a legal settlement, or who has been keeping their deposits small because someone told them that was the smart thing to do. That advice has cost people everything. This video could prevent that from happening to someone you care about. I will see you in the next one.